Hello and welcome to Simply Tax. It's Monday, October 11, 2021, and as we discussed in the last few episodes of the podcast in particular, you don't need me to tell you there is a lot going on in the tax world these days. Now, back in May in episode 123, we took a look at the proposed tax increases focused on high-income Americans that are being proposed to pay for the domestic portion of President Biden's Build Back Better agenda. And guests Holly Ponzer and Jeff Lehman discussed some of the considerations from a wealth planning perspective based on what we knew at that time. Since that conversation, House Democrats introduced their proposed legislative text on September 13 that was ultimately approved without amendment by the House Ways and Means Committee on September 15. And while there were some similarities to what the Biden administration is calling for, there are a number of key differences that particularly impact wealth planning for individuals and their families. And that's why I'm excited to share with you on the podcast today a conversation I had with Justin Miller, partner and national director of wealth planning at Evercore Wealth Management and managing director at Evercore Trust Company. Now, I was really looking forward to this conversation for a number of reasons, beyond just the timeliness of the topic, to include Justin's thought leadership, technical experience, and the fact that it turns out we have a lot in common. But I think I was most excited because, in my mind, he's a king. Here's a clip from our conversation on why that is, and also why tax Twitter is the best Twitter. We've known each other kind of through social media, which is sort of just a cool thing about, like tax Twitter and whatnot. But I have to tell you, you are definitely the king of puns and tax puns in particular. I mean, hands down, if there was a trophy or an award out there, it's going to you, Justin.
We should clarify the king of bad puns and bad tax jokes. These are dad jokes to an extreme.
Yeah.
So, at a certain point, you realize you're never going to be the best comedian, but you could be the best worst comedian. And so that's kind of where my jokes land.
There you go. Well, I mean, I think a good tax joke kind of falls in that category, if you ask me. So, but no, you do a great job with that for sure.
I was going to say a good plug for, social media and the tax community on LinkedIn and on Twitter, and that's, hashtag tax Twitter. And what's great nowadays is we get our news within seconds. I mean, when something comes out, it's not a matter of waiting for the next day. And don't get me wrong, there are so many great publications out there and articles, but when you're on the feed from a LinkedIn or a Twitter, what you're getting from the tax community is up to the second data of what's going on in DC, what's going on with the IRS, Chief Counsel's Office, Treasury rulings, regulations, cases that come out. We get it all immediately if in this day and age, when you're about to go to a client meeting, when you're going to have a discussion with another attorney or an accountant, you are as up to date as anyone in the world if you're following these tax groups and you're getting the best information as quickly as possible.
Yeah, absolutely. I can't tell you how many times I've done that. I did a presentation last month where I was up to them saying, hey, they got to check tax Twitter here for the latest, because you're absolutely correct. And I think I've enjoyed that so much. I've learned so much. And there's just some great tax minds out there like yourself, just helping to digest this stuff and be on the front end of it and talk about it, identify some of those situations that we just even talked about with the grantor trust provision. I mean, it's just invaluable from my perspective. So 100% agree. I'd like to invite you to learn more about Justin and find out just how many similarities there are between the two of us with the Beyond the Numbers video for this episode, which you can find on our Simply Tax YouTube channel. And with that, let's jump in and unpack the individual trust, estate, and gift proposals of the Build Back Better Act legislative text as approved by the House Ways and Means Committee.
I'll just kind of go down the list, starting with the income tax side. I tend to work with wealthy families, and oftentimes there are C corporation interests. So we could see the corporate tax rates going up. That just seems almost like a given at this point. There is sufficient Democratic support for it. It went way down with the Tax Cuts and Jobs Act at the end of 2017 from 35 to 21. So is it possible it could go back up to the proposed rate, highest rate of 26.5% as proposed under the House proposal? And the answer is yes, it certainly could go up. What's interesting, though, is to be clear, that is really going to only impact those corporations that already pay income tax. And those are corporations. So if you look industry-wide, these are like the banking industry, the oil and gas. They do report profits, they pay taxes. So it's going to be heavily weighted, that tax burden, to certain C corporation industries, whereas ones that get a lot of the press, such as like an Amazon with a zero taxes, it doesn't matter whether the rate is 26.5% or 96.5%. They're not going to owe taxes on either. So it doesn't really change that. But for most families, where it also comes in, and there's also some proposed changes, is what that means for qualified small business stock. Often you would see a lot of startups, especially in the Silicon Valley, are set up as C corporations, one, to help get private equity investments. It's easily understood. You don't have to worry about different partnership, LLC, waterfall type structures. So people understand C Corps, but those qualified small business stock benefits could go away.
Hold up. Did he just say there's a proposed change to the exclusion available under Section 1202? Recall back in episode 26 of the podcast, we explored if Section 1202 is for you with guest Rick Clausen, and he predicted that we would see an increased utilization of this sometimes historically overlooked, yet significant section of the Internal Revenue Code after the changes enacted under the Tax Cuts and Jobs Act a few years ago. With the proposed change that Justin just mentioned, and to see if Rick's prediction really held up, Rick will be back on the podcast in our next episode to help you determine if Section 1202 is through. The episode is due out next week, so if you haven't already, hit the subscribe button for the podcast so you don't miss out. All right, let's head on back over and hear more from Justin on what's included in the Triple B proposals.
But that's just on the entity side. And then we have to move over to the individual side. The highest tax rate could easily go from 37% back to what it already was a couple years ago, or a few years ago, 39.6%. That was the Tax Cuts and Jobs Act change to bring it down from 39.6%. We certainly could see it go back there. Now, to jump ahead, I know you'll probably ask, how did this compare to Biden's changes? And the reality is, for capital gains, there will still be a capital gains preference. Now, Biden proposed getting rid of that for people that make over $1 million. But there will still be a capital gains preference, but the preference won't be as good. The proposal is to say, rather than a top 20% rate, we're going to give you a top 25% rate. And that can completely happen. Once again, there's enough political support to push those capital gains back up. But I'm going to bring up a couple other income tax things we have to remember. We still have an extra 3.8% net investment income tax. Sometimes people forget that came about as part of the Patient Protection Affordable Care Act. Actually, it wasn't even part of the original act. The 3.8% tax, the net investment income tax, that was just kind of lopped on a week later, an amendment, the Healthcare Reconciliation Act in 2010, that said, how are we going to pay for this? Why don't we just throw in another 3.8% tax? It's not a Medicare tax. It's literally just an additional 3.8%. And it's not indexed for inflation. So anyone making more than $250,000, if you're married, $200,000 if you're not married. So we've got that additional 3.8% tax. And there's this new proposal for a 3% tax on top of all this tax for anyone making more than $5 million. A couple things I want to point out, though. It impacts trusts at much lower rates. So trusts are going to hit generally with the higher taxes, so 20 to 25%, let alone the extra 3.8%, at just over $12,500 under the proposal. So trusts will be in the highest tax bracket, much lower. And that additional 3% tax that hits people with more than $5 million, that's going to hit trusts at just $100,000. So we have to be very sensitive in the trust and estate world with these new proposed rules. Now, what's going to pass, whether it will happen, we're just going to have to wait and see. But we could very likely see a bump up in those income tax rules.
And you raise a really good point about the fact that the trust rate, it kicks in so much lower. That's always been the case, but it's becoming perhaps more expensive, I guess, from a tax rate perspective to be in those taxable trust situation. That's something that really, I guess, jumped out to me as well. Now, I have to ask you in the conversation, as I'm sure you've been having many of around the capital gains, around the proposed effective date, which would kick in for, they use that September 13th date, which was the date that it was introduced. What's your sense on that in terms of, has the die already been cast on this 25% rate? Again, assuming that that's the direction we go, or do you think that that's maybe subject to some change from what you're kind of hearing?
This is what's tough about the House proposal. Effective date means when does it actually apply? There are all these different effective rates for different things for the different proposals. Some start in January 2022. Some start on date of enactment, meaning when the president signs it. Some of them start on September 14th, going back to when this was originally proposed. So the first thing I want to address, and I've had a lot of conversations with clients and advisors on this topic. The first thing is some people have brought up, well, is this even constitutional? When we put our lawyer hat on, the only thing that the Constitution prohibits retroactively are changes to criminal law. And those are those ex post facto laws. The idea is that, Damien, if you or I did something right now, they can't change the law next year and say what we did was illegal and we can go to jail. So that's just a fundamental part of our Constitution. If it's not criminally illegal when you do it, you can't make it criminal after the fact. But that's only criminal law. Taxes is a totally different story. So I'll bring out what's possible, and then I'll bring out how likely is it to happen. But what's possible, just to put in perspective, we had an increase under the Clinton administration. The Omnibus Budget Reconciliation Act of 1993 was signed by the president, Bill Clinton at the time, in August of 1993, applied to the entire year. So any money you made as of January 1993, including, let's say you sold stock and had short-term gains and you thought you were paying one tax in January, come August, you find out, oh no, I owe more taxes. Totally legal, it happened. And in fact, President Clinton was reelected after that. So it didn't affect him, but I will point out retroactive tax changes tend to be unpopular. So while President Clinton was reelected, we did see the House and the Senate flip, partly due to some of those tax changes. The other thing I'll point out is constitutionally, is this even allowed? Has that ever been challenged? It turns out in 1994, we even have a Supreme Court ruling on it. U.S. v. Carlton, and it had to do going back to some tax changes in the 80s. And what happened was the taxpayer in a state had done some transaction, totally legal, totally under the tax rules, and Congress changed it the next year retroactively. And they went back, and here's this taxpayer threw up their hands. It went all the way to the Supreme Court. Taxpayer said, this has got to be unconstitutional. Are you kidding me? I would never have done this if I would have known Congress was going to change its mind and put this new law in, let alone that they're trying to do this retroactively. But the Supreme Court looked at it, and I'll give you sort of the quote. They said, tax legislation is not a promise, and a taxpayer has no vested right in the Internal Revenue Code. So long answer to your short question is, can it be done? Absolutely. There's pretty darn clear rules and laws that say there can be a retroactive tax increase. The question is, will it happen? It's politically unpopular. And at this point, remember, we're in a situation not just focusing on what the House has passed or willing to pass, but you've got a situation where you need 100% unanimous Democratic approval. You have to get 50 senators all to agree, which means all it takes is one senator from West Virginia or one senator from Arizona to say, I don't like this, and it's not going to become part of the final law.
That was a great explanation to that question, and just bringing about, right, that the tax law is only as permanent as it is. And when everyone says, oh, there's a permanent change, like, we permanently changed the corporate rate under the TCJA, right? And here we are talking about potentially changing it. So yeah, only as permanent as they make it, I suppose. So that'll definitely be interesting. But you talked about the different dates and kind of when they would go into effect. And as we maybe shift over to the estate and gift, and we can maybe layer in some trust here as well. I know there's particularly a proposal that's captured a lot of attention with respect to grantor trusts. I guess with that in mind, can you unpack some of those and what you're hearing and seeing there?
Yeah, so in the estate and gift tax world, and this is where I spend a lot of my time with families and with advisors around the country, some huge potential changes and different enactment dates, once again, are different effective dates. But let me start with the given in that, not a given, but the most likely situation, and that is the exemption amounts. Right now, a married couple can give away $23.4 million, no questions asked, no estate tax, no gift tax. They can set it up in trust for kids and grandkids and great-great-grandkids. If you go to places like Delaware with no rule against perpetuities, permanently free of estate and gift tax. And all you have to do, file your Form 709, your estate and gift tax return. There's some great planning opportunity. Now, that exemption amount with the Tax Cuts and Jobs Act was already scheduled to be roughly cut in half in 2026. So after 2025, 2026, already scheduled to sort of expire and then go back to some, inflation adjusted old rules. The new proposal is very simple, and there is enough support to make this happen. And really what they said is they didn't say we're cutting rates in half. What they said is instead of waiting until 2026, we're going to do that starting in 2022. They're just going to accelerate it a little bit. That has support, and that's very likely to happen. So first thing we want to focus on is just the easiest, and that is if you haven't used your exemption and you have enough money, then this may be your very last year. And what Treasury has already come back and said, and we have regulations, final regulations saying there's no what's called clawback, meaning this is a use it or lose it exemption. If you give 23.4 million away, you're fine. They'll never come back and question. Even if next year the two of you can only give away 12 million, doesn't matter. The other amounts are permanently set aside tax-free. So at the easiest level, that's a given, and that's effective starting January 1. But what's scaring the world of planners, which is possible, and that is all the changes to two things. One, valuation discounts. And that's the idea that a lot of families aren't just giving cash. A lot of families have limited partnerships or LLCs set up that have assets in them. And the idea is that if they're putting something worth $23.4 million, that's the fair market value that they're transferring. Because it's an LLC or a limited partnership interest, there's discounts for things like lack of control, because they're gifting something that is not a controlling interest. It takes other people to vote or make something happen. So there's a legitimate fair market value discount for that. The other discount is lack of marketability. These are private, closely held entities, and you can't just go out at the stock market and buy or sell these types of things. So because of that lack of control and lack of marketability, you can get some significant discounting when gifting. So it's not necessarily a $23.4 million asset if everything were to liquidate. With the 35% discount, maybe it's a $36 million interest with a 35% discount that's only worth $23.4 million for valuation purposes. That discounting is threatened to go away, and it's going to go away on date of enactment. So there's a lot of fear to rush and get these gifts, especially if you're using closely held districts. Now, there's an exception if it's an operating company or legitimate, let's say like a restaurant or manufacturing business. But for a lot of these entities they're much more passive oriented, they're legitimate entities if you're doing it correctly, but the discounting involved could disappear. And that brings out into what about these grantor trusts? And that's the big fear. The bread and butter of estate planning, when you talk about current gift and estate tax planning, grantor trust planning. And that means these trusts that you set up where the grantor pays the income taxes for the trust. And what that does is because the grantor pays the income taxes for the trust, first, it's very easy. Usually it's the grantor's social security number. It's just a flow through. For income tax purposes, you don't really care. But for estate and gift tax purposes, what you're doing is you're allowing the grantor trust to basically grow tax-free while the grantor is bringing down the grantor's estate value that will eventually be subject to taxes. And there's a lot of revenue rulings that support it. It's in the code. We have Revenue Ruling 85-13, where you can do sales back and forth, Revenue Ruling 2004-64, Revenue Ruling 2008-22. This is the bread and butter of estate and gift tax planning, are these grantor trusts. And the threat, though, is to say on or after the date of enactment, we're going to get rid of the ability to do grantor trust planning for estate tax purposes, meaning if you have a grantor trust that you create after that date, we're going to include that grantor trust in your estate. We're going to say that you have to pay estate taxes on it. So where's all the alarm? Why is everyone freaking out? Why is everyone rushing to do things? So first, it's effective on or after date of enactment, meaning if you set up these grantor trusts now before it's enacted, you're grandfathered, you're protected. These could be the last weeks and months that you can ever do this bread and butter of planning and have extra amounts going tax-free for kids, grandkids, great-grandkids. So there could be a limited time to put these into place. The other thing that's very scary, and this is the problem with Congress sort of rushing in and drafting these code sections, and maybe one day we'll get Treasury regulations interpreting it and IRS chief counsel ruling, but it's very vague on what exactly is grandfather. Now, it's clear that they've said any grant or trust in existence before that date of enactment, before the president signs the bill, you're good. But then it goes on to say, but if there's any kind of contribution, and I'll put the word contribution in quotes, that's going to have a negative effect, meaning you're going to either be taxed on any sales that you do in between this trust down the road, or if you add money to your grantor trust. Now, contribution's pretty clear if we think and we just put on our reasonable hat and say, okay, well, certainly if you add money to a trust, that's a contribution. I don't think anyone doubts that. But it doesn't tell us exactly what they mean by contribution, which brings up things like, what if you substitute property? One of the things that makes a grantor trust is this power of substitution. That means swapping assets of equal value. You're not actually contributing anything new. You're just moving assets, one asset in for an equivalent asset out. So there's no real money more or less. It's a perfect fair market value swap. But is that going to be considered a contribution? What about if you have a decanting? What if you have, which is, let's say we have a trust in one area and we want to move it to a trust, let's say in a place like Delaware with more favorable trust laws, and all the terms or most of the terms are going to be the same, or maybe we're going to tweak a term here or there. Is that a contribution to a new trust? Does that mean we're suddenly going to lose out on all of our benefits? Does that mean we're stuck? We no longer have the flexibility to make minor changes because it might be considered a new trust? Even for plans such as GRATs, where that these are more sophisticated tax planning strategies, but it's a grantor trust today. But what happens as it makes its payments out and eventually becomes a trust for the kids and grandkids? Is that a new trust? And we haven't heard even from the life insurance industry and those lobbying organizations. What about life insurance trusts? These irrevocable life insurance trusts, or ILITs. A lot of these were set up to own life insurance, and the idea is that premium payments come out every single year. But if a grantor has to add premium payments every single year, that's certainly a new contribution every year, which would mean those life insurance trusts will be included for estate tax purposes. So there are so many questions right now with that proposal. While at first it seems easy, everything that exists before date of enactment, you're okay. However, this whole idea of anything you might do after date of enactment could be a problem. That's what's causing a lot of fear and uncertainty right now.
I don't know, I guess from my perspective, it sort of caught me a bit off guard when that was included. And certainly there's been conversations around maybe targeting GRATs or valuation discounts, over the years in some of the proposals. But this is pretty, I guess, far-reaching, I guess we'll say maybe, in terms of its application. I mean, all those different circumstances and situations you just discussed, right? Anytime, obviously, we get about 8.5 pages or so, in this case, of legislative text, we're going to need a little bit more to understand it. And then that also creates some challenges. So how do you navigate that when we've only got the words on the page with the legislation? Let's just assume that that's what was enacted. How do we address those sorts of things? And then I guess, how does that enter into the planning that you would do in the meantime?
Without being able to go into everything, one, every client should be working with their advisors, hopefully a team of advisors. That means a good wealth manager, a good accountant, a good attorney. There's other professionals that are going to be involved. But this is the time to make sure you finally put these things into place, which begs the question, well, what should we put into place? It should be customized for every client. It depends on their facts and circumstances. But certainly for clients who have sufficient assets that can plan for children, grandchildren, and beyond, this could be a last opportunity to use up your exemption, state and gift tax, that $23.4 million. Focus on generation skipping transfer tax planning for some of those families, discounting, setting up these grantor trusts while you still can. You might be limited on what you can do in the future, but you can certainly start setting some of these up. For irrevocable life insurance trust, you can maybe fund them a little bit more now so you don't have to worry about contributions, future contributions down the road. Even on some of the other changes that are pretty scary that we don't know what's going to happen, even with IRAs. With IRAs right now, there are proposals was somewhat of a backlash against these mega IRAs and mega Roth IRAs. And so it's really targeting these 10 million and up IRAs. But it's not just about creating these distribution rules to try to prevent people from growing their tax-free growth in their IRAs and Roth IRAs above 10 million. But some of the scary things that are buried in there is that if you have a closely held business interest in your IRA or Roth IRA, but what about if you have an investment like a private equity investment in your IRA or Roth IRA? which a lot of wealthy families do. It's part of their overall portfolio. And that would involve things where you're an accredited investor or a qualified purchaser. Part of this proposed legislation says if you have any investment like that that requires that you to be an accredited investor or qualified purchaser, you're going to have 2 years to get rid of that investment. Well, it's not very easy to do. Even from a practical perspective, private equity, a lot of these have these sort of 7 to 10 year buy-in periods. They're on the books and records. You need an attorney to change titling. And it's not like owning a stock in a publicly traded company that you could just flip it in and out of your IRA. You can't get out of it very easily. It's like I said, it could be a 7 to 10 year commitment. But the legislation just throws out there that, oh, well, if you already own one, you got to get rid of it. You have 2022 and 2023 to get that out of your IRA. It doesn't tell you how to get it out of your IRA. It doesn't tell you if you sell it, if you can transfer it out. If you take it out, do you have to pay income taxes and a penalty on it? So there are a lot of scary things in this. But back to planning, well, one of the things we might want to look at is, if a client is contemplating putting a new investment like that before the end of the year, maybe delay, because there's just too much uncertainty. We don't want to be in an even worse position in the next few months, making your life worse by adding these investments. Now, once again, this legislation might be changed. We don't even have a final bill yet. So let alone, we don't know what's going to make it into the final bill, let alone what anyone's going to pass once it becomes part of a final bill. But it does bring a lot of scary things for clients. And that's where the advisors come in, is can we take the fear away? Can we at least focus on the things that have some certainty, like putting together and funding grantor trust now, completing whatever transactions we need to complete, spousal trust planning, where one spouse is taking care of another spouse and the kids in the trust with things like spousal lifetime access trust. That's the type of work. One thing I can assure you, for a lot of attorneys and accountants out there, valuation professionals, there's not going to be a lot of sleep over the next few months. I'm sure I can see you smiling, but
Yes.
It is going to be very busy. And anyone looking to do this isn't going to be something you can do the date before this law gets passed. You've got to be working on it now. Now, what you can do for flexibility is maybe you wait to sign it until we have some more certainty. Why don't you get all of the legwork done now, and you can take a little bit. But this is not something you can just snap your fingers and do when a final bill is going to the president for signature. This takes a lot of upfront work. And at this point, the poor industry around the professionals doing all this work are just swamped.
And I'm already hearing that of, wait, I need to find a good estate planning attorney. I need to find a good wealth manager. The guy I've worked with, the gal I've worked with, they're not available. They're not able to help me out right now. And maybe even just to go back to a comment you made earlier on about, obviously there's the technical and the lining up and getting the trust drafted and all of that and the provisions, but there's so much of the non-tax, I guess the family dynamic stuff and the, what are your wishes, even just the dynamics, the psychology between husband and wife of, what is your viewpoint of what we want to leave, our legacy to be, and what do you want to do with it? I mean, that all takes time to work through. So if you haven't worked through that part of it, even with the time that we would have remaining on the clock, so to speak, that almost isn't enough. I mean, there's certainly a lot there, and that is so important to the success of the planning from my perspective. I don't know, would you agree?
Oh, absolutely. In fact, if you were to take a survey, and we've had this discussion of people that have implemented plans, the ones that did the legwork in the beginning, working with their advisors, oftentimes a good wealth manager, not just running the numbers, does this make sense, but really explaining the strategy, what works, what it's used for, how to best utilize it. The people that have those discussions in advance are very happy with their plans after the fact. The ones that rush into it with only one advisor, whether, depending on who that advisor, and that's the only person they talk to about it, and they just went into it with pure tax planning and nothing else in mind, those are the ones that oftentimes have regrets that it wasn't necessarily the right fit for them and their family. The children or grandchildren don't really understand it, and it's not set up well for their future benefit to keep them motivated and incentivized to be successful pillars of the community, good, actually have good lifestyles and all of that. So the best thing, and I would just kind of echo what you just said, and it's that preparation in advance, running the numbers, making sure you understand the strategy, explaining the strategy so they actually know what to expect moving forward. Those are going to be the best and most successful plans.
I guess maybe with that in mind, are there some maybe things you would leave listeners with, or things that you think that they should be focused on here?
If I could sort of leave, what one parting thought for every client and frankly for every advisor, and that is the importance of a collaborative team. It's all about the team. That's what's great about our social media communities in the tax world, LinkedIn, Twitter, let alone our professional communities through CPA and legal organizations, but estate planning communities and local estate planning councils. The importance of working together as advisors for a client. Now, don't get me wrong. We all have those clients that like to silo their advisors. And that's maybe how they run their businesses or their life. And they think they're getting the best advice by only talking to their attorney independently and their accountant and their wealth manager and comparing what the three of them say and deciding, independently and thinking that's their best advice. But the reality is people are operating with different information. They're coming from different directions. They have access to different information. They understand the family in different contexts. The best approach for families, that if they want the best advice that's going to work with them, have those advisors work together. Meaning the wealth manager, the attorney, the accountant, all of these other specialists. If they're working together, you're going to give your family the exponentially higher likelihood that it's going to be the right plan. It's going to be implemented correctly. All the T's are going to be crossed. The I's are going to be dotted. It won't just be a good document, it will be implemented. And when you have that collaborative team, the family ends up better. You tend to avoid tax court. A lot of cases in tax court are from lack of teams working together. You avoid mistakes, and ultimately the family will be better off. So if I could leave you with that parting thought, collaborative team of advisors is the best way to take care of families.
Very well put. I couldn't agree with you more there, Justin. So, well, this has been a great conversation. I know it's one, I think I'd said it in the emails and before we jumped on here, that it's one I've been looking forward to. So it definitely lived up to the expectation, and hopefully we can have future conversations here as well, because there's just so much coming at us. And I appreciate your perspective and your insights so much. So thank you.
Well, thank you, Damien. And if anyone's hearing this for the first time, and I'd recommend, Damien's got great podcasts. He's got videos on YouTube. You can follow him on social media. It's always informative and entertaining. So thank you.
I enjoy doing it. So I'm glad you also find it entertaining, because I do try hard to make the tax as fun as possible.
and we got to support, the Cal community.
There you go.
We've got believe it or not, we've got an incredible group of alumni around the world. And I believe, I still argue with my daughter, who's now at UCLA, but there is that one ranking that says UCLA is the #1 public school, but I focus on all the other rankings that still say Berkeley's #1. So at least we have a lot of pride in our school.
Absolutely, we do. So, no, that's great. Well, yeah. So thank you again.
All right. My pleasure, Damien. And thank you all for your time.
Now that was a lot of tax fun, if you ask me. And I really appreciated and took a lot away from my conversation with Justin. Please learn more about Justin in the show notes of this episode, available at bkd.com/simplytax, which is where you'll also get links to the resources mentioned today, to include that Beyond the Numbers video, where you can find out things like Justin's favorite place on the UC Berkeley campus, and just how he came to teach about tax in the first place. Please also let us know what you think of Simply Tax by dropping us an email at simplytax@bkd.com, or leaving us a rating and review on iTunes or wherever you get your podcasts. Finally, you can connect with me on social media and start a conversation. You'll find me out on LinkedIn and on Twitter at Damien Martin CPA. You'll also find me on Instagram at TaxDad and on YouTube by subscribing to our Simply Tax YouTube channel. I'm Damien Martin. Thank you for listening, and go Bears.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.